2026 ETF Outlook: Resilience, Innovation, and Strategic Shifts. As the exchange-traded fund market enters 2026, the prevailing sentiment is characterized as uncomfortably bullish. Momentum from the previous years has sustained a robust rally, yet valuations in key sectors remain stretched, creating a complex risk-reward landscape. Investors are navigating an environment defined by shifting global policies, stubborn inflation pockets, and a new interest rate regime. The overarching theme for 2026 is resilience, with portfolios needing to be anchored against macroeconomic volatility while remaining agile enough to capture growth. The focus has shifted from riding a broad market wave to identifying specific pockets of durability that can withstand potential policy shocks and economic cooling. The technology sector, particularly artificial intelligence, continues to be a primary driver of market performance, but the narrative is maturing. The initial hype phase has transitioned into a buildout phase, focusing on the picks and shovels, the infrastructure, utilities, and hardware required to cover AI at scale. However, the extreme concentration of returns in a handful of mega-cap tech stocks has raised alarms about portfolio fragility. As a result, 2026 is expected to see a broadening of market breadth, with investors increasingly looking toward mid-cap ETFs and diversified tech strategies to mitigate concentration risk while still maintaining exposure to sector growth trends. In this volatile environment, the era of purely passive set it and forget it investing is ceding ground to active management. The complexity of the 2026 landscape, marked by rate volatility and credit dispersion, favors active ETF strategies that can dynamically adjust duration and credit quality. Fixed income ETFs are enjoying a renaissance, with the mantra "income is back in fixed income" driving flows. Investors are favoring active bond ETFs that can capitalize on yield discrepancies in corporate credit, securitized assets, and short-duration bonds, using them not just for safety, but as a genuine engine of return. Finally, the search for value and diversification is pushing horizons beyond domestic borders. A widening valuation gap between U.S. equities and international markets is prompting a rotation into emerging markets, Europe and Japan, where structural reforms and lower entry prices offer attractive upside. Concurrently, alternative asset ETFs are becoming standard portfolio diversifiers, from cryptocurrency ETFs, which are stabilizing into a distinct asset class, to private credit and commodities. Investors are utilizing these tools to decouple their portfolios from traditional equity and bond correlations, creating a more robust defense against systemic shocks. We welcome you to subscribe to our YouTube channel and visit our website to learn about our financing and investment legal practice. Thank you.